as the surprise interest rate cut this morning seems to be suggesting policymakers are concerned and they want to make a gesture. 10 basis points is almost like not a big deal, right? It's a small gesture, but at least it shows that they care.
There's a big debate going on in terms of how far the Fed has to go. The equity market and the credit market maybe have gotten a little bit ahead of themselves in terms of pricing in a soft landing.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Surprise rate cuts. China unexpectedly lowers key borrowing costs as retail sales and industrial production miss forecasts. The yuan and bond yields slump. Well, $532 million a day, that's the daily profit of oil producer Saudi Aramco in the second quarter, the most ever by any listed company. And investors look to this week's Fed minutes and speakers, including Esther George and Neil Kashkari. What clues will they offer on whether the FOMC will go big with hikes next month? Now, first thing is first, so let's check on the markets. So we look at treasuries. We look at, of course, European stocks gaining some 0.1%. So some of the gains that we saw earlier in the trading session, where we saw 0.3% gains, are abating somewhat. Now, oil, iron ore, a lot of the energy complex actually falling after some disappointing data, but also the surprise interest rate cut from China could further put pressure on the outlook for the global economy. Technology still on the high. Bloomberg U.S. dollar index 1,264. It'd be also interesting to look at treasuries as the inverted yield curve continues to invert. If you look at the bond curve remaining deeply inverted, again points to worries that the Federal Reserve campaign of monetary tightening against high inflation will spark a U.S. recession. Let's go to the European map to see if there's any big difference between, for example, Germany and the FTSE here in the UK. And you can see the DAX down 0.1%, the FTSE gaining 0.1%, but not huge variation for the countries. Now, China's economic recovery unexpectedly weakened in July as fresh COVID outbreaks across the country weighed on consumer and business spending, clouding the growth outlook and prompting the central bank to deliver a surprise interest rate. Here's what some of our guests have been saying.
Well, the set of data are not exactly very pretty.
Yeah. We are constructed on third quarter, but it doesn't mean in all sectors the economy will perform very strong.
The surprise interest rate cut this morning seems to be suggesting policymakers are concerned and they want to make a gesture. 10 basis points is almost like not a big deal, right? It's a small gesture, but at least it shows that they care.
We're going to see continuous diverging performance across industries. Those policy tailwind sectors like infrastructure, manufacturing, new energy cars, these actually will perform much more strongly.
This year, we're probably lucky again to see 2 to 3% growth in the Chinese economy. Once Xi Jinping gets through the 20th Party Congress this October, November, will there be a course correction on the economy or not?
Now, for more on all of this, let's bring in our Bloomberg Chief Asia correspondent. He's Enda Kern. So, Enda, what's the main key takeaway from the data this morning?
Weakness across the board, Francine. July was meant to be a month of recovery. The third quarter was meant to be better, but actually we saw weakness in retail sales, in industrial output, in investment, where public spending still outstrips private spending, with more bad news on the property market in terms of both investment and house prices and sales. And all of that is what forced the central bank to respond by cutting their key interest rate for the first time since January. Now, that move by the central bank certainly won't be in and of itself a game changer for China's economy, but it does speak to the idea that the authorities now are quite concerned about the breadth and depth of the downturn across the economy, and they're going to pull whatever levers they can to try and arrest that.
So how will policymakers respond to this from now? And I mean, the cut wasn't significant, but it kind of showed a resolve from policymakers in China.
It did show a resolve. I think the two questions are, what will happen with COVID zero and what will happen with the property market? And on COVID zero, the authorities have been consistent that they're sticking with this a very aggressive approach to controlling the disease. They want to get that public health dividend, and to do so they're willing to have or to take at least some economic pain. That has been the message from the top down. On the property side of things, we'll have to see if they do ease up there or start injecting money into some of those troubled developers or into other channels to get money into the housing market to try and rev up activity there. I think it's going to be less a story about the central bank and more a story about what will happen on the fiscal side of things? Will we see more spending at local government level, for example? So I think big questions about policy in the coming months, and a big question about when that pivot might come.
What does it mean for the global economy, Enda?
I think at the very least, Francine, you have to say China isn't much of a pillar of support for global growth right now. We had the IMF warning only a few weeks ago that the world economy is on the brink of a recession. We see warnings of a recession in the Eurozone, pretty sluggish Japan economy. Obviously, the US economy has a strong jobs market. But unlike past downturns when China certainly was there to rev up global demand through its stimulus and through its own domestic consumer base, that isn't happening this time around, and it's clear that China isn't going to be a dynamo for a global recovery.
Thank you so much, Enda Curran, there with the very latest, of course, on the Chinese and world economy. Now, for more on all of this, we're joined by Anna Stupnicka, a global macroeconomist at Fidelity International. Anna, how do you look, of course, at this surprise cut in the global context?
Morning, Francine. I do agree it's more of a signal. It's not a game changer. But I think the authorities wanted to surprise the markets and send that signal, and that was pretty successful. But from here, the focus is really on fiscal, and the focus is on a zero-COVID policy. And as long as those restrictions are in place, it's hard to be much more optimistic from here.
So, Anna, what does that mean for the repercussions on the global economy?
Yeah, I think this is quite interesting because we clearly have developed markets heading into quite an abrupt slowdown or recession in places, and China is not going to cushion that blow to the global economy. China might start exporting disinflation, but it's also exporting low growth. And that is not helping. And I think these policy differentials between DM central banks, particularly the Fed and PBOC, will mean even stronger dollar from here, which is quite hard for the rest of the economy, as we know, particularly for emerging markets.
And overall, when you look at emerging markets, how much pressure, how difficult will it get for a lot of them that are also very tied to the dollar in the next 6 months?
Yeah, I think it will be very difficult, particularly given they're being hit by a multitude of shocks. They were in Ukraine, of course, related to increase in energy and agricultural prices, and now the increase in cost of funding. And the Fed is just focused for the time being on the domestic economy. The domestic economy is strong, looking at the hard data, not at the soft data, actually. But the hard data is strong so far. And so they will keep on pressing with their hawkish stance, with more hikes, putting more and more pressure on emerging markets. So I think maybe not in the very short term, but in the medium term from here, we will see stresses across emerging markets, potentially some debt crisis as well.
Debt crisis, are there countries at the moment that you're warning investors not to go into or get out of?
Well, not for the time being, not specific countries, but I think we clearly know the ones that are very much exposed, countries like Turkey, Egypt, and some Asian countries in Indonesia, very much exposed to the current shocks. I think they might have some issues ahead.
Anna, when you look at dollar, does it go ever higher from here? What's the catalyst for it to retrace some of their gains?
Well, again, I think we're all looking for the same thing, and that is a pivot from the Fed. Looking at the financial conditions, we do think that this is very disturbing for the Fed. They have eased, and there is a massive gap between what we're seeing in the macro data and what we're seeing in the market. As you know, the markets have rallied so much. They are looking through all the troubles, all the shocks, and this is problematic for the Fed. So the more easing we see in the financial conditions, the more tightening the Fed will have to do. And in fact, maybe rates will go even to a more restrictive territory from here. Not our base case for now, but I think it's certainly possible. That means the dollar will be high until that pivot comes.
Anna, thanks so much. Anna Stupnicka, there, a global macroeconomist at Fidelity International, stays with us. We'll talk a lot more, of course, about the Fed and energy in Europe. But coming up, we also preview some of the big earnings reports from Europe this week, including the German chemical giant Henkel, as price pressures start to pinch. That story is next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, it's also big earnings week for Europe, with some of the continent's biggest reports due to file, and what is an increasingly challenging economic environment that's putting pressure on prices. Well, for more, we're joined by Bloomberg's April Roach. April, great to have you back on again. So how's the cost of living crisis impacting, for example, German chemicals maker Henkel?
Good morning. Yes, so Henkel reported slightly better than expected results this morning. The company also raised its organic revenue forecast for the year. It did, however, warn that its earnings were impacted by input cost headwinds. And we've seen that Henkel faces a bit of a dilemma in that it can either sacrifice its margins to boost volume or raise prices further, which could potentially put longer-term growth at risk. And it's also a question of whether consumers will be willing to accept those potential price increases, because if management pushes prices too far, then consumers could potentially swap to cheaper brands.
So how's Carlsberg, on the other spectrum, beer maker, expect to manage some of the inflationary headwinds? Who has that pricing power?
Yeah, so Carlsberg is the next big brewer scheduled to report this week. The company last week raised its full-year outlook based on a strong business performance year to date. It cited strong on-trade recovery in European markets and strong results in many Asian markets as well. It also added that these factors more than offset commodity and energy cost pressures in the first half of the year, but going into the second half of the year could be a bit more challenging for Carlsberg as consumers face rising energy costs.
So corporate payments maker, for example, increasingly more competitive. What are we expecting from Adyen, the Dutch payment firm?
Yes, so investors are said to be piling back into tech stocks, which could be really good news for Adyen. Adyen shares have been going up since June after a series of monthly declines. And the Dutch payment firm, as you said, which handles transactions for companies like Uber and McDonald's, ended last year on a really strong note. Online shopping during coronavirus lockdowns really helped Adyen gain its market share. And analysts have also pointed out that Adyen's strong and growing US presence and reputation, and also the rollout of new products, still bodes well for positive growth for Adyen.
April, thanks so much. April Roach there with some of the biggest earnings reports later this week. Now let's get back to Anna Stepnicka, global macroeconomist at Fidelity International. Anna, what's your take on Fed? So we'll get onto earnings and I guess the read across onto your world. But are we expecting too much from the Fed? They can't really fix a supply shock inflation.
They can't, but they need to keep hiking to control inflation expectations. And we have seen some reduction in inflation expectations in market-based measures, not so much yet in survey consumer-based measures. And I think this is what they're looking at. This is what they're targeting. Those hikes will likely continue until, again, that growth damage, particularly in the labor market, becomes more obvious, and until inflation starts declining as well. We know it's softer. The last print was softer already, but it's mainly on the headline for the time being. So more from the Fed to come, at least until the end of this year.
So I know that you have a 70% probability of a hard landing scenario. Can they even avoid a hard landing at this point?
I think it would be very hard. Maybe if they pivot right now and they stop hiking, obviously financial conditions have eased. So I think that could potentially mean the US goes into a very mild recession, but recession nevertheless. But if they continue hiking, again, together with what's happening in Europe, what's happening in China, I think that probability of avoiding that hard landing is pretty low.
If you see a significant downturn, Anna, in U.S. activity, where do you look at it first? Or do you look at activity, or do you look at productivity or housing?
Well, we are looking at the soft data. The soft data now across the board is signaling significant weakness, going to the levels that we saw in the last recessions, either COVID recession or global financial crisis, particularly driven by consumer. But we're seeing that in the industry already, in services. So soft data is very soft, but hard data is still pretty strong. So what we are looking at is actually that link, the translation of this softness into hard data. And of course, it's the labor market, first of all, that we're focusing on, like the Fed, and inflation itself.
Anna, what's your take on Europe? It seems that a lot of the markets are actually quite complacent because we talk about, industry by industry, certain industries having to shut down because we don't have enough gas, especially going to winter months. But that doesn't seem to be priced in.
Yeah, it's strange. I think it's becoming consensus. Of course, the European recession. I think we have believed in it for a while now, but the question is still on the depth, on the duration, on the timing. But markets are complacent, and it's hard to be really out of consensus here. They are complacent. We see a potential shock, of course, to the German economy, but to the whole of the euro area of the order of 3 to 4%, potentially up to 5% in Germany, given all the headwinds. So it's hard to see how markets can continue rallying given this situation. And by the way, the war is not over. It might not be in the headlines all the time, but it's still there. This phase of the war is likely to be even more intense than we have seen as the Ukrainian forces are trying to retake some of the territory in the south. And that means more disruptions on the energy front and more shocks to growth.
Thank you so much, Anna. And a very important reminder from Anna Stupnitska, their global macroeconomist at Fidelity International. Now, coming up, markets digest the data coming out of China, which show its economic recovery unexpectedly weakening in July. So we'll get the latest on that story next. And this is Bloomberg.
This month, as the world watches inflation rise, employment rebound, and fiscal policies react, all roads lead to Jackson Hole for the Kansas City Fed's 2022 Economic Policy Symposium. Bloomberg's all-star team is live as policymakers and financial insiders discuss the economic issues and solutions that keep the world's money moving. Coverage starts August 25th, only on Bloomberg Television and Radio.
The much maligned 60-40 portfolio.
A 60-40, portfolio, generally speaking, for most investors would make sense because at some stage the bond markets will make a comeback.
We need to give it some more time. There may be better ways to go than 60-40, but I think as a base case, it still makes a lot of sense.
That 40% in bonds is probably close to 5 or 10. And I actually think they're increasing it pretty dramatically at the moment as they're looking for secure yield.
Going outside into other real assets, real estate, private equity, private credit can be a healthy addition to the portfolio and really help diversify your returns because 60-40, as I mentioned, has been a challenging portfolio construction exposure to have.
Bloomberg guests there with their views on whether the 60-40 split will beat inflation. Let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Water levels at a key waypoint on the Rhine River are expected to steady at an extremely low level this week, adding to Europe's energy crunch. Many barges cannot transit past the marker at a point west of Frankfurt when the water level is below 40 centimetres. According to government data, it is already about 35 centimetres and is set to drop to 30 centimetres today. A U.S. congressional delegation landed in Taiwan for a two-day visit yesterday. They are set to meet with Taiwanese President Tsai Ing-wen and other lawmakers. The trip risks keeping tensions with China high after House Speaker Nancy Pelosi's recent visit to the region. The UK's opposition Labour Party has proposed extending Britain's windfall tax on oil and gas companies to fund a total freeze on energy bills over the winter. The plan, to be announced by the leader Keir Starmer later today, will put renewed pressure on the government to act. Analysts predict the typical annual household energy bill could top £4,200 by January. Salman Rushdie is starting looking to recover 2 days after being stabbed at a lecture in New York. AP has quoted his agents saying the author is now on the road to recovery. Rushdie is said to have been removed from a ventilator on Sunday and is now able to talk. The author of the controversial novel The Satanic Verses suffered serious injuries on Friday after being stabbed multiple times shortly after taking the stage. Tributes are pouring in for Wall Street and beyond for Anush Jain, the Cantor Fitzgerald president and former Deutsche Bank co-CEO. Jain's death at the age of 50 was announced on Saturday after a 5-year battle with cancer. He's been credited with building Deutsche Bank's investment banking business and turning the German lender into a global trading powerhouse. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. China's economic recovery unexpectedly weakened in July. We'll have a full roundup of that news. Surprise rate cuts. Well, China unexpectedly lowers key borrowing costs as retail sales and industrial production miss forecasts. The yuan and bond yields slump. $532 million a day. That's the daily profit of oil producer Saudi Aramco in the second quarter, the most ever by any listed company. And investors look to this week's Fed minutes and speakers, including Esther George and Neil Kashkari. What clues will they offer on whether the FOMC will go big with hikes next month? Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. This is what the market is telling us. Now, we're seeing a bit of a reversal from the early gains that we had here in European stocks. When you look at U.S. stocks, futures actually pointing to a lower start. We did have some gloomy China economic outlook. That's cooling some of the stocks rally that we saw earlier on. Let's also look at Bitcoin, 24,100 or 026. Now, Treasury yields ticking higher, bond curve still remaining deeply inverted, pointing to worries that the Federal Reserve's campaign of monetary policy tightening against high inflation will actually spark a U.S. recession. I'm looking at dollar higher. Now, the UK's main opposition, Labour Party, wants to extend Britain's windfall tax on oil and gas companies, with proceeds used to fund a total freeze on energy bills over the winter. Now, joining us now is Bloomberg's Lizzie Burden, as we look also at some of those tabloids today. So first of all, Lizzie, what can we expect from Keir Starmer?
Well, he's already on the media round this morning. He's dominating the front pages, as you can see there, which is rare for Keir Starmer. It's not often he does that. But this is because he's been so criticised for not taking advantage of the policy vacuum left by Boris Johnson's zombie government. He's a lame duck until the 5th of September, really. Even Gordon Brown, the former Prime Minister, has come in and told us what he would do if he were in charge. So finally, Starmer setting out his plan, telling us that he would raise this windfall tax again. Of course, this was originally a Labour idea that the Conservatives took, so he would want to do it again and use the money to help freeze the energy bills, which is causing the pain for consumers, really.
And Lizzie, overall, I mean, this will have a policy implication as the two candidates vying to be Prime Minister, I guess, could take it on board.
It certainly puts pressure on them too. Liz Truss, though, has said that she wouldn't introduce a new windfall tax. Rishi Sunak says he's open to the idea and he's done it before, so if he did win, he could do it again. But it doesn't look good for the Conservatives to yet again be stealing Labour's clothes, being on the back foot.
What about the strikes?
It's not just transport anymore, or the strikes. It's also the barristers, the doctors are threatening to strike. This has been dubbed by the UK press as the summer of discontent, so just like the 1970s winter of discontent. The reason is the unions say, because look at inflation, it's set to hit more than 13% in the fall. So what better time to try and use their bargaining power? The jobs and inflation data this week are set to show that the labour market's still tight, inflation's still rising. So the workers should have the upper hand, but Truss says that she, if she were in power, she would see it as her job to control wage rises. Yeah. It's a difficult argument to make, though, Francine, when the public sector isn't really the one that's responsible for the price rises.
Yeah, so true. Lizzie, thank you so much. Lizzie Burden there with the very latest on the UK. Now, China's economic recovery unexpectedly weakened in July. Fresh COVID outbreaks across the country weighed on consumer and business spending, clouding the growth outlook and prompting the central bank to deliver a surprise interest rate cut. Now, how surprising was the cut? Well, all 20 economists polled by Bloomberg had forecast the rate would be left unchanged. We're now joined by Keyu Jin, Associate Professor of Economics at the London School of Economics. Keyu, first of all, great pleasure to speak to you today. What are you looking at in the Chinese economy? You understand the Chinese economy like no one else, really, that should have alerted us to this.
Well, the signs have been, around for a long time, really rising housing prices for so long. This is actually the third cycle already in the last decade where the government has been trying to curb a very heated property market. But, a method that has a combined effect of too hasty and too draconian can backfire. And that's what we're actually seeing right now. The Chinese economy is suffering from a combination, of course, pandemic controls, geopolitical aggressions, property contraction, and a general loss of confidence. And in particular, what does this policy mean, and how transparent can it be going forward?
So, Keyu, what does today tell us actually about this alarming slowdown? We thought that PBOC or policymakers would keep a very cool head about it. I know this is a symbolic cut, but do you think they're willing to do a lot more to support the economy?
Well, for sure, this is not enough. And there is room for further monetary and fiscal expansion. But really, if we're talking about the property market, it's a little bit too late and too little. Now, to backstop really a crisis of confidence, you need to do much more. And in particular, you need to send a really strong message. And it's not just about helping consumers and home buyers and loosening the mortgage market that is enough. You actually need to give a lot more relief to property developers, the very entities they're trying to put an end to this unscrupulous borrowing and overexpansion in the last decade. But really, it's a confidence problem, and you want to break this vicious circle.
So how quickly do they need to act if they want to break the circle?
It's a little bit late, let's say, and it's going to be very hard to achieve the targets for economic growth this year. But I think what the economy and generally the companies and the households and the banks and the financial system is looking for is really overall, support for the property market and more clarity on when, the pandemic controls are going to start to loosen up. And instill more confidence in the economy. I think it takes time to build confidence, and time is not afforded to these property developers, according to which, to some statistics, 80 out of 100 of the largest property developers are under severe stress right now.
Yeah, and we're looking at, home prices falling some 11th for the 11th month as the mortgage crisis, of course, in China is deepening. Is this symptomatic of something bigger, or is this actually where it starts?
Well, I don't think that there's going to be a full-blown financial crisis or a housing price crisis. For one thing, Chinese households have, 24 trillion RMB of saving every year, with a 55 trillion RMB of debt overall. You pay a 5.5% interest on it. It's actually enough to support mortgage repayments. And there is support for housing prices. I mean, China is a really interesting country where you got to own a property. So more than 85% of the households own a property. And, what I find is really interesting is that you have a gender-skewed country where the marriage market is particularly competitive for men, and you can raise your eligibility as a bachelor if you own a property. And there are multiple wallets in a household to support, the young kids to buy a property. So there's urbanization. I think there's bottom line support for housing prices. So it's unlikely going to fall really much further. And also the banking crisis, yes, a quarter of banking assets is tied to the property, but unlike American banks, banks are state-owned. They're not 7 or 8 intermediary steps and chains that leads to this complex network of, financial system. There's only 1 or 2, so plain vanilla loans. And also foreigners are not so exposed to Chinese property assets, although many of them are going to have to take a haircut.
Keyu, I love the fact that, of course, it increases your eligibility if you own a nice house. It does make for awkward conversations maybe on that first date. Talk to me about the Chinese consumer. Are they holding strong?
Not so much. Let's say there's the wealth effect from, property price decline. There's, again, this confidence issue. They want to delay their home purchases. They want to delay their durable good consumption. You just have to have more clarity on where the economy is going and transparency. And also in terms of investment, there's, also a lot of uncertainty. So it's really precautionary saving at the moment. And we're really seeing some of the worst economic situation in decades in China.
Keyu, on the political front, so China's also, announced some patrols around Taiwan to protest other senators visiting. Is there a read across with the more the U.S. is seen as provoking China, the more they need to prop up the economy? Are the two linked?
Geopolitical factors is an everyday embedded now in terms of Chinese economic planning. There's, on the one hand, a strive to greater independence in technology and commodities, and there's also a greater push for a domestic demand boost. And so all of these factors are baked in. But unless China is pushed to a corner, we're not likely to see dramatic moves, at least not yet.
Keyu, as always, thank you so much for all of the great insight. Keyu Jin, they're Associate Professor of Economics at the London School of Economics. Now, coming up, Saudi Aramco posts the biggest quarterly profit of any listed company ever. We'll have the details on that next, and this is Bloomberg.
The gas storage itself is not sufficient.
We are facing a crisis at the moment. It's been produced by the cut-off of Russian gas, but it tells us yet again just how volatile and uncertain fossil fuel prices are.
Gas prices will remain very high, and it also may result in some disruption.
We cannot magically get sort of tens or hundreds of gigawatts of renewable energy before winter. So it is a matter of saving energy. It's a matter of securing sources.
There should be more obligatory measures to reduce consumption.
The first step, obviously, is to become independent of Russian supplies, which in the end can only be managed by additional imports, mostly LNG.
Here today, we've seen the reduction in the gas consumption by about 10% in the EU.
I think the effect of this crisis will be that Europe will be further down the path to emissions reductions than it would otherwise be.
Business leaders and regulators are discussing the energy crisis on Bloomberg, and of course we'll bring you up to date as the situation develops. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Japan's economy recovered to its pre-pandemic size in the second quarter, with growth picking up after COVID curbs were relaxed. GDP grew at an annualized pace of 2.2%, below economists' median forecast of 2.6%. Consumer spending, which accounts for more than half of Japan's economic output, led growth. Water levels at a key waypoint on the Rhine River are expected to steady at an extremely low level this week, adding to Europe's energy crunch. Many barges can't transit past the marker at a point west of Frankfurt, when the water level is below 40 centimetres. According to government data, it's already at about 35 centimetres and is set to drop to 30 centimetres today. Wells Fargo, the bank that once churned out 1 in every 3 home loans in the US, now plans to shrink its vast mortgage empire. Bloomberg has learned Wells Fargo is no longer committed to ranking #1 in the business. That comes after years of struggles to avoid costly regulatory probes and hits to the bank's reputation. Peloton is embarking on a sweeping overhaul, which includes cutting 800 jobs, hiking prices, and also shutting stores. The CEO told employees the changes and are essential, making the company cash flow positive again. Peloton stock is down nearly 90% over the past 12 months. And tributes are pouring in from Wall Street and beyond for Anshu Jain, the Cantor Fitzgerald president and former Deutsche Bank co-CEO. Jain's death at the age of 59 was announced on Saturday after a 5-year battle with cancer. He's been credited with building Deutsche Bank's investment banking business and turning the German lender into a global trading powerhouse. And that's your Bloomberg Business Flash. Francine.
Leanne, thank you so much for the update. Now, Saudi Aramco has posted the biggest quarterly adjusted profit of any listed company ever, driven by high crude prices and production. Well, Bloomberg's Middle East energy market reporter Anthony Di Paola joins us next. Anthony, first of all, is there anything else behind the Aramco record profit apart from high oil prices?
I mean, high oil prices were the main factor here. Aramco has just been pumping crude out, increasing production throughout the year, even though they were subject to OPEC plus quotas, where they had been reducing production to help the market recover from the COVID pandemic. They'd been rolling back those cuts and so slowly increasing production over that period. So at the time as prices were going up, they've been putting more oil onto the market. So that's been really helping. At the same time, we've had this real big crunch on refined products. So that's gasoline, that's diesel, all these kind of transport fuels that we've been using so much more of. And that's really helped them boost the profit for their refining division. That's been up by something like 175% was the increase in EBIT for that division, Francine.
So, Anthony, how are they going to be spending this money?
Yeah, I mean, a lot of that is going to be going back into their wells to produce more oil and gas for use in the kingdom, in power plants, electricity, petrochemicals, and that's helping expand the Saudi economy. And then oil, they're going to be pumping that out, selling more of that. They're looking to increase exports of crude oil as well as they start to use less of that at home for those industries. So it's really going to be investment in that and an investment to increase the capacity so they can put more oil onto the market as they see demand continuing to increase throughout the rest of this decade.
So apart from that, and this is reinvestments, do we know how much they'll give back to shareholders through dividends or buybacks?
Well, they're maintaining their dividend policy. The annual dividend is about $75 billion. That's the world's biggest dividend payout. And so far, they're maintaining that. They've had free cash flow that was nearly double what the dividend payout is. So finally, they're making the money to make that payout. We don't know yet if they are going to increase that later this year, although we have been hearing increasingly from some analysts discussing it that they would expect to see that with these big bumper oil prices. Some of the other international oil companies have been giving money back to shareholders. We did see Aramco make a small gesture with some bonus shares given to shareholders, but we haven't yet seen that that dividend increase.
Yeah.
The gearing ratio is coming under control, so they may come to that. We may hear from management about that later today.
And the other story that really caught my eye is something that you've been covering all along, and certainly from this morning, where we found out that actually Prince Al Walid had a significant amount of exposure to some of the Russian energy companies, and it's unclear whether this was pre or post-war.
Yeah, exactly. He made those investments in about 3 Russian energy companies in February. We don't know whether that was before the invasion or after. So we don't know what really was the thinking there. Maybe he saw kind of a fillip coming on those shares if an invasion was avoided. Of course, that didn't happen, and those securities have gone down. We did see a lot of Saudi Arabia support for Russia after the war. You know, they didn't throw Russia under the bus as the U.S. would have wanted when the U.S. was criticizing Russia for that invasion. A lot of people have been questioning, you know, what's the financial benefit for Saudi Arabia from Russia? We don't see a lot of investment going in. I think that same argument goes for this Al Walid investment. You know, he put the money in. Has he gotten anything back yet? We don't know. At these prices, he hasn't, Francine.
Thank you so much, Anthony. The Middle East, of course, our Middle East energy market reporter, Anthony Di Paola. Now, coming up, it's been a while since it grabbed our attention. Bitcoin briefly surpassing $25,000 on Sunday for the first time since mid-June before slipping back amid a broader crypto rally. So we have more on that story. That's next. And this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's turn our attention to the crypto space. Yesterday, Bitcoin briefly surpassed $25,000 for the first time since mid-June, before slipping back as momentum continued from cooler than expected U.S. inflation data. Now, for more on all of this, we're joined by our Bloomberg crypto reporter. She's Emily Nicole. So, Emily, thanks so much for joining us. If you look at Bitcoin, it did appear to have a bit of a rocky start this morning after a bit of a run-up in the weekend. So what exactly is going on?
So yesterday we definitely saw a bit of a rally for Bitcoin. It was coming off the back of some more payroll data or jobs data from the US anyway on Friday, which seemed to suggest that, there are fewer rate hikes in future, or at least less monetary tightening than we thought. And all of that helps to contribute to a better environment for risky assets like crypto. But this morning, as you said, it's definitely been a rocky start. It went up to 25K again this morning and then has gone down below 24K. We're now seeing about a percentage down. A broader crypto rally as well has also kind of weaned off, and all of that contributes to soured bets for Bitcoin.
So, I mean, overall, it does seem like we've had a bit of a broad rally when it comes to crypto in the last month or so.
Yeah, in the last month or so, as you point out, like the data that's been coming out from regulators has been broadly positive in terms of what they expect to do with monetary policy and with economics, and that then helps risky assets like crypto. So for Bitcoin, it's definitely been bouncing off that, and that kind of points towards how investors view these assets now. They're almost part of the traditional risky asset basket, not like last year when everything was a fad or FOMO.
So are you expecting this to continue, that it's becoming more mainstream and therefore it will become more stable?
Whether or not it'll be stable is another matter. But I think definitely it's still a volatile asset, right? Like it's lost $1,000 today, and that's definitely a big drop if you were to think about what it's like compared to a different asset that's not crypto. But definitely over the last year, what we've seen is that crypto is becoming more and more correlated with traditional tech stocks, with the S&P 500. That correlation point has been at 0.6 for as long as I can remember at this point. So definitely behaves like any other risky asset. And that kind of lends itself to the fact that we do see these ups and downs as and when economic data comes out.
And Emily, I mean, talk to us about the difference between Bitcoin and actually some of the other crypto assets.
Yeah, so in the last few days, we've seen a lot of differences actually between Bitcoin and its younger sister, I guess I'd like to call it Ethereum or Ether, because Ether itself is due to undergo a major upgrade next week, maybe around the 15th is what we're expecting at the minute, to its underlying network. That means it's going to be shifting away from the way it currently mines tokens and validates transactions to a different method that is supposed to be a bit more environmentally friendly, a bit more efficient, will help reduce things like transaction fees. And because that has been in the pipeline for so long, and we're now coming to those final stages of when it'll begin, people are kind of pricing that in. Investors are betting a lot on Ethereum optimism, and that's also bouncing other coins that are similarly based on that blockchain, like Dogecoin and the other underlying networks.
Emily, thank you so much for the great update. Emily Nicole there on crypto and Bitcoin. Now, Bloomberg Surveillance Early Edition continues in the next hour with Matt Miller, Kailey Leinz, and here in London, Anna Edwards. Gloomy China economic outlook, of course, is starting to hurt the stocks rally. We also look at Treasury yields ticking higher, the bond curve remaining deeply inverted, pointing to worries that the Federal Reserve's campaign of monetary tightening against high inflation will spark a U.S. recession. So we'll have a look at that, the dollar gaining, and this is Bloomberg.
We're not in a recession now, but it's coming, and there's going to be a calm before the storm.
I think you have to be concerned that there's still going to be some volatility going around.
Markets need to be on guard and need to be vigilant.
I would be careful of running back to the playbook that worked for the last 10, 15 years.
We debate how much China has held down U.S. inflation over the past 20 years, but it's been significant.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
10 a.m. in London, 5 a.m. in New York, 5 p.m. in Hong Kong. Our top stories today. China's central bank surprised. The PBOC cuts interest rates to boost an economy hurt by COVID lockdowns and a property slump. Another U.S. congressional delegation visits Taiwan. Beijing responds by adding military patrols around the island. And a major shift for Wells Fargo. It will shrink the mortgage empire that once accounted for 1 in every 3 US home loans. Good morning. Welcome to Bloomberg Surveillance Early Edition. I'm Guy Johnson in London with Matt Miller and Kailey Leinz in New York. Anna Edwards is off today. Kailey, the action is in Asia.
Yeah, and in China specifically, Guy, after that surprise rate cut from the PBOC, cutting both the 1-year and 7-day lending rates by 10 basis points. So that really was an interesting weight on the session overall in Asia. Yes, you had the MSCI Asia Pacific Index positive by about 0.1%, but that was largely due to outperformance of Japan. Meanwhile, Chinese stocks were down because, of course, that rate cut was quickly followed less than an hour later by a series of disappointing data points from the Chinese economy. Retail sales, investment, all are missing expectations. So that took the CSI 300 down about 0.1%. In the bond market, we saw the Chinese 10-year yield coming in 8 basis points at 266. That is the lowest level going back to May of 2020. And meanwhile, the Chinese yuan is one of the biggest underperformers among the Asian currencies, weaker against the dollar by about 0.6%, trading right now at 678, Matt.
All right, we are looking here in terms of U.S. futures at a loss of about 0.5%. Now, we had a really strong cash trade on Friday. We were up about 2%, more than 2% on the NASDAQ cash trade. So giving up some of those gains in the face of these Chinese concerns. We're also seeing investors buying the 10-year treasuries and really across the curve, pushing yields down right now. 282.76 is the level we're looking at here. And the U.S. dollar index is also showing some strength. So this is really signs that investors are looking for some kind of safe haven, because you saw the reverse, for example, previously on treasuries, and this dollar strength has just continued throughout the morning. Bitcoin, on the other hand, is down right now. More than 1%. That tends to be correlated with risk assets, so that makes sense, but still holding over $24,000 a piece. Guy, what do you see in terms of the European gains?
They're very fractional, and to be honest, if you take a look below the surface, Matt, they are very defensive. So you've got healthcare bouncing back today, utilities are up, food and beverage is tracking a little bit higher. That is a very defensive sector story that we are seeing below the surface of this map behind me. So European equities gaining a little bit of traction this morning, but not much. Remember, Europe highly exposed to what is happening in China. That's where the narrative is. That's where the weakness is right now. And Europe's got its own problems to contend with as well. So European equities really just drifting sideways at the moment. We are watching the cable rate as well, down by around 0.5% today. You've got more weakness coming out of the housing market here in the UK. Higher rates beginning to bite. We're going to pay attention to that to see whether it rolls over further from here. You've also got crude coming lower as well on the Chinese data. There's a multitude of factors coming together here, but nevertheless, China was and continues to be a big consumer of crude. The softness in the data worth paying attention to. And then we come to the Rhine. What is happening on the Rhine this morning? We're at 32 centimetres. We are below the 40 centimetres at which the Rhine at Kaub near Frankfurt is navigable. We are below that level. Effectively, very little traffic going up the Rhine from Frankfurt. That is going to have, Kailey, a major industrial effect, and we're going to continue to watch that feeding into the data over the next few weeks.
Yeah, but climate crisis exacerbating an energy crisis, which exacerbates an economic crisis, Guy. Definitely something we will continue to watch, not just today, but during the entire week ahead. And there's plenty else we will be watching this week as well, including U.S. retailers reporting their earnings results throughout the week. On Wednesday, we'll also be getting U.S. retail sales data, so some key figures to gauge the strength of the U.S. consumer and the U.S. economy as a whole. Also on Wednesday, the Fed will be releasing minutes from its July meeting. What do they signal about any kind of idea of a pause or what the shape of the September hike may look like? We'll also be getting Eurozone GDP data out later on, and EU CPI data will be coming on Thursday, Matt.
All right, we'll be looking very closely at that. Right now, I think the world is focused on China's central bank surprise and, of course, the bad data, Kailey, that you listed. The PBOC is forced to reduce rates after weak retail, industrial, and investment data all point to a sharply slowing economy. Enda Curran, our chief Asia economics correspondent, joins us for more. So, Enda, how bad is it?
It's quite bad. July was meant to be the month of recovery for China's economy. Instead, we had a suite of data today, all surprising on the downside. Retail spending less than expected, industrial output weaker, investment weaker, more signs of weakness in the real estate market also. And that's what forced the central bank to cut its key interest rate for the first time since January. Now, that move in and of itself will not be a game changer for China's economy. It won't turn things around, but it speaks to the new degree of urgency among China's policymakers to try and arrest what is now a much steeper slowdown than expected across the whole economy.
How steep will the slowdown be? What do you think we're looking at in terms of GDP now this year? And more policy action, what sort of size will we be looking at?
Well, that's the big question, Guy. What kind of a pivot will we get on policy now? Until recently, they've been quite disciplined. They haven't rolled out the kind of fiscal stimulus we've seen in past downturns. The central bank has been offering support, but not hugely so. The question is, will we get a pivot on COVID zero? All the messaging on that so far has been there will be no pivot on COVID zero. Then the question becomes, what will it do on the real estate side of things? Will the government try and inject money into those developers and try and really arrest the slide in prices and activity there? So I think most of the focus will be on government spending on the fiscal side, and let's see what they do with real estate, more so I think than any abrupt pivot from COVID zero or any major action from the central bank.
All right, Bloomberg's Enda Curran reporting from Hong Kong. Thank you so much. Meanwhile, elsewhere in Asia, another U.S. congressional delegation, this one led by Democratic Senator Ed Markey, is visiting Taiwan. China says it is fighting back by adding more military patrols around the island. The congressional trip comes less than 2 weeks after one by House Speaker Nancy Pelosi led to unprecedented Chinese military exercises. Anne-Marie Horder, Bloomberg Washington correspondent, joins us now with more from D.C. So, Anne-Marie, is this just the U.S. trying to send a signal that it's not going to back down on the Taiwan issue, or is there another motive for this next round of visits?
Well, Speaker Pelosi's visit was really the one that sent shockwaves throughout China, really because of her rank. Not saying that Ed Markey, the senator from Massachusetts, isn't important, but it's a different level of status of Speaker Pelosi going versus Senator Markey. What we've seen in the past is a number of congressional delegations have gone before, but we haven't seen in 25 years the Speaker of the House. And already what we have from the Chinese defense and the Chinese military talking about patrols, talking about the United States, and showing again that they're testing China and that this is an infringement on their sovereignty. We haven't seen the response that we had when it was Speaker Pelosi less than 2 weeks ago, which included live fire drills, as well as was likely ballistic missiles that went over the island of Taiwan and even Japan sang and ended up in their economic exclusion zone. But it does test the waters of potentially maybe more blowback from Beijing.
Speaking of blowback, senators are now asking to see the classified or confiscated documents from the FBI search at Trump's Mar-a-Lago residence. What do we know?
This is really a bipartisan issue right now. You have Republicans and senators. You have Mark Warner of Virginia. You have Marco Rubio. They're both chair and vice chair of the Senate Intelligence Committee. And what they are asking for is for the FBI to disclose to the panel, because obviously these are classified and sensitive to materials, that they want to be able to see this. And really, obviously, this has become very political. But in Congress, everyone wants to know what was in these documents, these 11 boxes with classified top secret information that was seized from the president's private residence and resort in Mar-a-Lago. But by and large, what you hear in Washington is partisan when it comes to the rhetoric. The Republicans want to get to the bottom of why this raid was justified, while the Democrats are really looking at the gravity of the situation and why the former president even had these documents in the first place.
Thanks, AMH. Anne-Marie Horder joining us from D.C. on the latest, not only on what is happening with this trip to Taiwan, but also what is happening surrounding Donald Trump. Now, after years of dominating America's mortgage market, Wells Fargo is planning a major retreat from home lending. Here to discuss the implications of this strategic shift inside the country's third largest bank is Bloomberg's Charlie Wells, appropriately named. Charlie, let's talk about the size and significance of this shift.
Yeah, guys, so this really is Wells Fargo taking that famous stagecoach in a very different direction. So Wells was quite unique in the mortgage lending space. So after the financial crisis, with, of course, its connections to America's mortgage market, other major lenders in the United States backed out of this sector, but Wells Fargo charged right forward. Over the past decade, they actually brought in $57 billion in fees from their mortgage operations, which is hugely significant. So this change means that some of the negative sides of this are happening. So mortgages, of course, are incredibly incredibly regulated, they're incredibly complex, and this seems to be an indication that executives inside the bank are taking a look at some of the missteps that have happened even over the past year. So we had that $250 million fine over lapses related to distressed borrowers, and also some reporting from Bloomberg News that found that there was a significant gap in approvals for white versus black people who wanted to refinance. So this seems to be executives saying it's just not worth it to go so hard anymore.
Where does this, Charlie, leave the U.S. housing market? I mean, Wells Fargo is an incredibly important supplier, is an incredibly important supplier of mortgages.
Yeah, Matt, that is a really great question. I think it's something that everyone is trying to figure out as we continue to get indications that the U.S. housing market is slowing down, right? We've got mortgage costs going up. We've got economic uncertainty making buyers less likely to become customers of banks like Wells Fargo. When you look at the mortgage market as well, we have seen layoffs at a number of mortgage brokers over the past few months. And also when we think about the ramifications for this within financial services, we see this increased trend of financial disintermediation where large lenders aren't necessarily playing every role in consumers' lives. We're seeing competitors like Rocket Mortgage take up some of the market share that Wells Fargo had before. So this is going to bring out significant changes in the way that Americans buy homes.
All right, Bloomberg's Charlie Wells, great reporting. Thank you so much. And of course, you can read today's Big Take on Bloomberg.com or by typing NI Big Take into your terminal. Meanwhile, in other banking news, Reuters is reporting that several major Wall Street banks have begun offering to facilitate trades in Russian debt in recent days. Most U.S. and European banks, of course, had pulled back from the market in June after Treasury banned U.S. investors from purchasing any Russian security as part of economic sanctions for invading Ukraine. So we'll continue to keep an eye on that story. But first, we also want to check on some stocks moving in pre-market trading here in the U.S. And I have to begin with Bed Bath & Beyond, which is one of the meme stocks that has seen a very real resurgence in recent days. It's up in 12 of the last 13 sessions, higher by 182% over that time, really for no good reason other than that it signals that some speculative fervor may be back in certain areas of the market, and is continuing those gains today, up about 9.7% before the bell. But a lot of stocks are moving lower, and many of them tied to the commodities complex, as you see commodity prices down in part due to concerns around Chinese demand after that string of disappointing economic data from China overnight. One of those being Freeport-McMoRan, the miner. It's down about 2.7%. And also in relation to that China story, you're seeing some of those big tech ADRs also way down in pre-market trading. Alibaba won. It's down about 1.2%. Of course, it has a sensitivity to that Chinese consumer story, Guy.
Absolutely. We're going to look at the macro element to all of this as well. Could the Chinese currency come under significant pressure? How will Beijing respond? Derek Halpenny, MUFG, Head of Research for Global Markets, EMEA, joining us in the next half hour to give us a take on what is happening there. Iris Pang, ING's Chief Economist for Greater China, also weighing in on that story. That is all coming up. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kailey Leinz here in New York. Guy Johnson with us out of London. I'm looking at an incredibly shrinking VIX, which is pretty interesting considering all of the headwinds, geopolitical, energy concerns, economic crisis, as Kailey was listing earlier, that are hitting this economy, confronting this economy. Nonetheless, we see skew trending up, and maybe that's how investors are hedging these risks. Simon White of Bloomberg Markets Live joins us now to walk us through why we see such little volatility, or at least such little a rise in the volatility indicator that we all rely on. Simon?
Oh, hi, Matt. Yeah, very good question. I mean, equity volatility is kind of the dog that's not barking right now. I think there's a number of reasons for it. I mean, you mentioned the skew there. I think we've seen a couple of things there, like you've had call volatility has risen. So we've maybe seen that reflected in some of the, the meme stocks that we've, Bed Bath & Beyond, AMC, these sort of things. So I think that might be pushing up some of the call volatility. But at the same time, I think tail risks are being underpriced. We've seen relative to the call volatility rising. We've seen put volatility falling, which is kind of unexpected given the amount of uncertainty there, given where the Fed is, all these sort of things.
Is it possible to gauge how cheap the VIX is?
Very difficult in its own right. You have to look at it relative to a lot of things, but this is where it doesn't make a lot of sense to me. It's low relative to realized vol. It's low relative to at-the-money implied vol. It's low relative to cross-asset vol. It's also low relative to longer-term vol. And the problem with that, of course, is it makes it very hard to go long the VIX because the negative carry, you have to slide down the curve. So that maybe is one of the things that's holding it back.
Simon, what about in other asset classes? I'm looking at a significantly stronger dollar this morning off the back of that weak Chinese data. What is FX volatility looking like?
So FX vol, as I say, has kind of been rising relative to other volatilities. We've also fixed income vol is quite high. So it's kind of makes the VIX look even more of an outlier here. I mean, the dollar really is very interesting in its own right. It's been rising. And it'll continue to rise, I think, as long as the Fed is looking like it's taking rate hikes much further than everyone else. But really, when you have that effect, the Fed raising rates, it creates a lot of ripples across a lot of assets across the world.
Simon, make it easier for me to understand, in layman's terms, why it's hard to go long the VIX. You said something about negative carry and you have to slide down the curve. What do you mean?
So when you put like a trade like that on, you put it on in the futures. And when you have this very steep curve, you're putting it on at a much higher level. And basically, if nothing happens, you slide down that curve. So your volatility is going down when you want it to go up. So that's the curse of negative carry.
How much of this is seasonal?
There's a seasonal aspect to it, but I think it's very difficult to talk about seasonals in the sort of very volatile world that we're in right now. Normally in quiet times, I think seasonals make more sense. But right now, we've seen so much big moves that it's very difficult to see how your seasonals are going to have like as much of an impact as they would normally have.
Well, and of course, we're in a season, Simon, where we're not going to have that much Federal Reserve action, or at least any decision on hikes until September. From your assessment of these markets, have they overdone it on the expectation that the Fed's going to cool off?
Well, I think this is really what doesn't make sense to me. The Fed has been very explicit that it's going to be less explicit in offering guidance going forward. And in that sense, okay, the market might be right, we're going to get rate cuts next year, but if it's wrong, it's going to be potentially very wrong because inflation is a very non-linear situation, and that means that rates might go up a little bit higher, but the risk is they could go up considerably higher. If you look at Taylor rule, you're looking at another 500 basis points. So to me, it shouldn't be that tail risks are getting priced lower. You should be rising tail risks, and that would add to the VIX right now. And that's what really is kind of incongruous to what's going on.
So protection is cheap. We're going into some fairly big events. Jackson Hole's coming up. We've got Fed meetings in September. There's other data that we need to be paying attention to between now and then. When would you expect things to start to normalize?
Normalize in the sense of?
Well, the VIX going back to what you would ascribe to being a more reasonable level, i.e. when do you think traders are going to step up and go, now's the moment I need to start taking action? We've obviously had a big run into this. Vol's come down, but I'm now going into Jackson Hole where the Fed could push back. I'm now going into the September rate hikes, potentially when the Fed could surprise. When do you expect to start seeing this changing?
Jackson Hole, I think, is a big risk event. But I think already we're seeing one thing right now. If you look at the VIX itself, you can buy call options on the VIX. So the VIX is low. If you think it's going to be higher, you can buy call options.
Yep.
Already traders are now buying considerably more call options than put options. And when you look at that ratio when it spikes, and it's spiking right today, that has often preceded rises in the VIX. So maybe we're beginning to see something right now.
The process beginning to unfold. Simon, great stuff. Thank you very much indeed. Simon White of Bloomberg Markets. The VIX may be about to move. Keep an eye on that one. Check out what exactly the analysis surrounding all of this is. You can do that very simply on your Bloomberg terminal. MLIV Go on the Bloomberg. This is Bloomberg.
Now keeping you up to date with news from around the world, here's the first word. In the UK, the Labour Party has proposed extending the windfall tax on oil and gas companies. Lawmakers say the proceeds should be used to fund a total freeze on energy bills over the winter. The plan will put pressure on leadership contenders Liz Truss and Rishi Sunak to come up with ideas to mitigate the cost of living crunch. Russia's President Vladimir Putin is offering to expand relations with North Korea. He sent a congratulatory message to Kim Jong-un's regime for its Liberation Day holiday. North Korea has been stockpiling artillery for decades. That's led to speculation it could supply weapons for Russia's war in Ukraine. And tributes are pouring in for Keyu Jin, the Cantor Fitzgerald president and former co-CEO of Deutsche Bank. Jin's death was announced Saturday after a 5-year battle with cancer. He spent 2 decades at Deutsche Bank and transformed it into a global trading powerhouse. Keyu Jin was 59.
This is Bloomberg Surveillance Early Edition, and here's what you need to know. China cuts. The PBOC is forced to reduce rates after weak retail, industrial and investment data all point to a sharply slowing economy. Taiwan tensions rise again as a U.S. congressional delegation led by Senator Ed Markey touches down on the island. Beijing responds with fresh military action. And mortgage moderation. After a series of scandals, Bloomberg learns that Wells Fargo is planning to retreat from its prime position in America's home loan market. I'm Guy Johnson in London. Matt Miller, Kailey Leinz in New York. Anna Edwards is off today. Matt, what's it looking like pre-market?
Well, we're seeing futures off. Maybe not completely surprising considering all the disappointing data that we got out of China and considering the gains that we saw on Friday. We were up almost 2% on the S&P, more than that on the NASDAQ, so we're giving up some of that, at least in today's futures trade. We have had a really fascinating turnaround, and I think when I look at my worksheet, which is your worksheet, Guy, because I stole it from you, this is the most interesting move that I see in markets today. The 10-year yield, which had been climbing, then turned around and came down around 4 o'clock this morning, New York time, 9 o'clock London time. And that is, I think, around headlines coming out of Taiwan or out of China that they're starting fresh military actions there. We have investors seeking safety in the dollar as well. The Bloomberg Dollar Index continues to rise right now at 1268. And Bitcoin coming off, which makes sense with other risk assets, but still holding up over $24,000 a piece. Kailey, what do you see in terms of the pre-market movers this morning?
Well, one other asset to keep an eye on that wasn't on your board is oil, Matt. WTI is down about 3.5%, sub $90 a barrel today, and in part that is due to demand concerns out of China with that disappointing data overnight really overshadowing the news of a rate cut coming from the PBOC. So while those commodity prices are down, it is in turn weighing on correlated assets and pre-market trading, or correlated equities in particular. Occidental Petroleum, Devon, Marathon Oil, all down in the ballpark of 2.5% to 3%, and it's feeding through to the metals complex as well in material stocks like Freeport-McMoRan, which is down about 2.7% before the bell, Guy.
You got there first. We're seeing the same thing here in Europe, Kailey. You are seeing the commodity stocks under pressure. It's not only oil, but it's also the miners as well. Bottom end of the stock 600 this morning. Top end, much more of a defensive bias in the market this morning. So the healthcare sector's bouncing back. You're seeing food and beverage tracking a little bit higher. So defensive tilt to the market in terms of the sector story. But that means in aggregate that the stock 600 is up just a little bit. We're up by 0.3%. The cable rate under a little bit of pressure. The dollar's broadly weak across the piece today, and that goes for euro dollar as well. And what we're seeing, therefore, is a little bit of weakness that is beginning to ripple out, and that can have a big effect. The dollar, when it moves like this, can have a very big effect. UK house prices also coming under pressure, a further factor for sterling to consider. Brent's down. Kelly was just mentioning what is happening there, and we continue to see what is happening in Germany as a big problem as well. The Rhine is now below 40 centimetres, which is the marker for navigability on the Rhine. Matt, we're at 32 centimetres, stabilising a little bit, but still
disturbing.
At very low levels.
You know, for someone, you know, who lives in the in the realm, using metric terms, what is that in inches?
Just below 16 inches.
All right, excellent. So we now all understand how low Rhine River levels are. Let's get to our next guest. Respected for decades for providing a decent profit and pleasantly low volatility, the 60-40 portfolio generated an 11.5% loss so far this year. Is it time to put that strategy to rest? A question it seems that we're always asking. Or is it just the matter of modifying some of your holdings? Here's how investors responded to the latest MLive Pulse survey.
Oh, the much maligned 60-40 portfolio.
A 60-40, portfolio, for generally speaking, for most investors would make sense because at some stage, the bond market will make a comeback.
We need to give it some more time. There may be better ways to go than 60-40, but I think as a base case, it still makes a lot of sense.
That 40% in bonds is probably close to 5 or 10. I actually think they're increasing it pretty dramatically at the moment as they're looking for secure yield.
Going outside into other real assets, real estate, private equity, private credit can be a healthy addition to the portfolio and really help diversify your returns, because 60-40, as I mentioned, has been a challenging portfolio construction exposure to have.
So it's interesting, one of the things that the 60-40 has not had to deal with over the last few years has been significant currency volatility. We are now getting that currency volatility, particularly in the form of a significantly stronger dollar. One factor behind all of this, obviously, is the slowdown that we're seeing in the rest of the world. China, no exception. The data out overnight causing the PBOC to cut rates. Is there more to follow? What impact could that have on the Chinese currency, the yuan? Let's try and answer some of these questions. Derek Halpenny, MUFG Head of Research, Global Markets, EMEA, and International Securities. Derek, good morning.
Morning, Guy.
The Chinese have started cutting rates. The currency is going to respond. They're probably going to have to do bigger rate cuts further down the road. How weak could the Chinese currency get?
I think obviously if we're in for a sustained period of monetary easing, that certainly is going to put downward pressure on CNY. I pause though, because it's not a completely obvious answer, and I think you have to also take into account what's happening on the trade side. And over the last 3 months, we've had a trade surplus equal to nearly $280 billion. That's the largest on record. Now, obviously, it's partly related to the weak import story that resulted in the monetary easing, but it also reflects 18% annual growth in exports. So even though we've had capital account outflows, bond markets, equity markets, the balance of payment statistics last week showed nearly 100 billion of outflows in Q2. It just doesn't match what's happening on the trade side. And until that changes dramatically, I'm quite reluctant to become bearish on CNY and CNH. So yes, today, CNH up, or dollar CNH up 0.5%. This was a surprise because only last week in the quarterly monetary policy report, it was actually slightly hawkish. Yep. The interpretation was that they're more concerned about inflation. So this big surprise has resulted in what's happening today. But ultimately, it might be premature to be calling for pronounced CNY weakness at this point in time.
I am, though, starting to hear more and more people talking about the fact that we may have seen a peak in the dollar. Your thoughts?
No, I don't think so. I think what's very interesting now I'm talking the short term because, our view was that equity markets were probably going to drop in the region of 30-35%, and that would prompt the pivot from the Fed. So as equities were coming down, the dollar would strengthen further, the pivot would come, the dollar would reverse. But we haven't had that. Financial conditions are easing. Now, the Fed will never come out and say they don't want to see the equity markets moving higher, but ultimately, it's complicating what they need to do.
They've come close to saying that.
And I think it's going to result in short-term rate expectations lurching higher. The data's actually picking up as well. Gasoline prices are down from $5 to $4. That's a big
$4, yeah.
That's a big impact for consumer confidence, and maybe the retail sales data this week is going to be stronger than expected. So I think over the short term, when you look at what's priced for the rest of this year, there is a chance the markets are going to start pricing in more.
They've come pretty close to saying that equity markets, that Wall Street needs to feel some pain, that the economy is going to take a hit, and they continue to argue with Mr. Market, Derek, saying we're not going to pivot. That's not going to happen. We're going to continue to raise rates until we, vanquish our inflation enemy here. How far do you think they go?
Well, I think when you look at the very short term, there's about 118 basis points priced for this year. Even if they do kind of revert from 75 to 50, which based on the inflation data last week is very plausible, given what's happening potentially on the consumer side in terms of some pickup in confidence, some pickup in consumer spending, that could result in the markets then starting to consider 50 basis points at the 3 remaining meetings this year, which would result obviously in 150 basis points more than what's priced in now. And I think that's the type of scenario that I think the market's going to start pricing over the short term. I do actually think inflation is going to come down next year. So I think the broader picture is correct, but we need to get through much more tightening and perhaps more than what's priced at the short end of the curve. And that gives the dollar that further lift that I'm talking about.
Well, on the subject of the short end, obviously yields at the short end are significantly higher than they are at the long end. Right now, 2s10s inverted by 43 basis points. How much deeper do you think that inversion can get, Derek?
Again, I had a deeper look at this in the FX Weekly that we did at MUFG, and my conclusions were that we're highly likely to get to levels of inversion that we haven't seen since the 1980s. And based on the 9 episodes of 2s10s inverting going back to 1978, there is a clear kind of link with dollar performance in terms of the depth of the inversion. So if I'm right and we go below minus 50 basis points, which is roughly where we got to in 2000, and we get back to levels of the early 1980s, I think again that is a catalyst for the dollar to strengthen further. So we're expecting euro dollar to pretty quickly lurch lower from here and go back below parity for a longer period than what we had briefly.
Yeah, didn't feel like it lasted very long. Derek, nice to see you. Thank you very much indeed. Derek Halpenny, MUFG, Head of Research, Global Markets, EMEA and International Securities. Thank you very much indeed. We're going to continue to focus on what is happening with China. Iris Pang, ING's Chief Economist for Greater China, joining us next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Later today on Balance of Power, an interview with Rubini Macro Associates Chairman and CEO Nouriel Roubini. That's at 12 p.m. New York time. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Guy Johnson in London. Anna Edwards is off today. In China, the central bank unexpectedly cut its key interest rates. The PBOC is ramping up support for an economy that has been hurt by COVID lockdowns and a deepening property downturn. New data show that prices for homes fell again in July, plus industrial output and retail sales were weaker than expected. Joining us now to discuss is Iris Pang, ING Chief Economist for Greater China. So, Iris, just last week, the PBOC was out talking about how it doesn't want to go through with massive stimulus given the threat of inflation, and yet clearly there is a growth deterioration that they're reacting to. How much further do you think they're willing to push easing?
You mean the monetary policy?
Yes.
So I think monetary policy does play a role, but not the biggest role here in this downward cycle. We may see the PBOC reframing itself from further cuts, because when they cut the MLF by 10 basis points today, at the same time they withdrew liquidity. That means they are actually in a very dilemma situation that whether they should ease or not. So they tilt down the interest rate but pull liquidity. It means that overall interest rate in the market in a week may actually bounce back to the level that we have seen a week ago. But we need more fiscal stimulus, and I believe that there will be more fiscal stimulus on infrastructure investments.
Okay, and to that point on the fiscal and monetary side, clearly the PBOC doesn't operate independently of the government and the Communist Party, and I'm wondering how much pressure there is in China on the political side ahead of the party Congress, and how you think that may factor into some of these economic decisions.
I think it's the PBOC. We can't say that it is under pressure of the party, because the PBOC is part of the government in China. It is structured like this. So they discuss what measures to use, either fiscal or monetary or a bit of both, or how to combine the both effects. So now I see that the monetary is a supplement, and the main drug will be the fiscal stimulus.
It doesn't seem that much different than other central banks in terms of its independence or lack thereof. I wonder about the COVID zero policy. How much further is Xi Jinping willing to push on that? Because it seems to be one of the biggest brakes on growth.
True. And I also worry about that. But what I have seen so far, in this round of COVID in Tibet and also in Hainan, the two travel destinations for mainland Chinese. Although they have clusters of COVID cases, the treatment of lockdown measures are more flexible compared to back in May and March to May in Shanghai and even compared to Beijing. Beijing was that time more flexible than Shanghai. So they are now adopting a more flexible approach, trying to limit the number of days in terms of quarantine, and the number of days depends on the COVID spread. So it is not really a fixed date of quarantine. That is actually quite helpful for economic recovery. But as long as we have quarantine here in China, it will from time to time hurt the economy.
Well, we've seen certainly some pain in terms of unemployment. I think the youngest cohort of potential workers, 16 to 24, right now we're looking at 20% unemployment. A fifth of those people don't have jobs. How important is that?
It is very worrisome situation for consumption, because this group of people actually consume large amounts of their salary if they have a job, and now many of them don't have a job. This will create a lot of consumption issues and also social issues. I'm not referring to social unrest, but other social issues like psychological issues. This will put burden on the whole economy. And I believe that state-owned enterprises has a role to play here. Usually, when unemployment was very high, state-owned enterprises will hire more people in terms of part-time and contracts.
Iris, final quick question. Europe looks like it is going into a recession. If Europe goes into a deep recession this winter, how quickly does that feed back into the China data?
If you mean recession in the US or a recession in China?
I mean, Europe's going to have a recession. At the moment, the trade data is favoring China, i.e. imports are relatively weak, but exports are relatively strong. Europe is a big component part of that. Were we to see European demand slowing significantly, how does that fit into the China data picture?
Usually that feedbacks into export orders, and it will be a lot earlier than trade data and industrial production data. It will be 2 months earlier. But the European orders for holidays, for example, Thanksgiving and Christmas and New Year's, have been placed in summer this year, already placed. So when we see another big orders, that will be for April, and that will be after February's, the Chinese New Year. We will have to wait until that we see really a feedback effect. But I am quite worried about that feedback effect, because it is not only Europe, it's also about the US.
Iris, on that note, we will leave it. Thank you very much indeed for the analysis. We greatly appreciate it. Iris Pang, ING's Chief Economist for Greater China. Thank you very much. Now, later on Balance of Power, we're going to hear from George Magnus, Research Associate at Oxford's China Centre. That conversation, 12:30 p.m. New York time. Do not miss it. George has great insight into what is happening in China. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kailey Leinz in New York. Guy Johnson with us out of London. Let's get over to Tom Keene right now, co-anchor of Bloomberg Surveillance, the original. And Tom, so much focus on Asia, on China's economic data, as well as more action to come from the PBOC. What's your focus today?
Well, my focus is to read End to Current and to read the good people of Bloomberg News in China. This is a complex story. It's flat out complex. It's not going to change. Its cursory analysis isn't going to do it. Let's go to the cursory analysis. It's a chart of real GDP, and it's taken year over year. So this is the grimmest point. Down we go to 0.4% off that 10% growth. and then 5% growth, pandemic dynamics, and down we go. And Matt, what is so important about this analysis is so much of it avoids the impact of COVID. I think it is grossly underestimated what COVID has done and their COVID policy has done to their economic growth.
Yeah, the pursuit of COVID zero definitely has some side effects, you could say, Tom. Obviously, we're seeing that ripple across asset classes today. Commodity prices are down. The dollar is stronger. Who are you going to be speaking about those moves with today on the program?
We're going to start exceptionally strong here in 7 minutes with Kit Jukes of SocGen and then move on forward. Peter Hooper will join from Deutsche Bank. And this is really the beginning of our Jackson Hole coverage. We're taking Jackson Hole as seriously as we always do, but we're really going to move on, Kailey, to a careful analysis of where the major central banks are as we move to Wyoming here in about 14 days.
All right, looking forward to the coverage today and, of course, from Jackson Hole later on. Tom Keene, thank you so much. Now, as for what else we are watching today, I'm going to be watching 13F filings for the second quarter. They are due today to the SEC, basically going to give us some insight into what large family offices and hedge funds were doing in what was a really bruising period for investors, the likes of Tiger Global, for example, that have had a really rough 2022. So what are they buying? What positions did they exit, Matt? We're going to get some details and clarity on that, and we'll look for all of that cover.
Yeah, that'll be interesting to follow, of course, as it always is. I'm also looking forward to see what Donald Trump's next move is, or the Department of Justice's next move, because they have released the warrant, and now we see that certain senators are asking for the papers, the actual confidential material, to see what the contents of those boxes looks like. Now, I'm still sort of waiting for the payoff. You know, what's going to come out of this from the Department of Justice, or what is Donald Trump going to do to build on his support that, you know, he's clearly gotten from his base after this search was executed by the FBI?
It's amazing to see how this is playing out, Matt. What am I watching? Well, over the last couple of years, we've all been amateur virologists. Then we all became amateur armchair generals. Now we're all here in Europe, Matt, Kailey, becoming amateur hydrologists because of these pictures here. The Rhine levels are falling. They're continuing to fall. Some signs of stabilization. But yeah, that's what we're all doing now. We're all becoming hydrologists. If it rains, which is expected to this week, how quickly does the water go into the ground? Or does it just run off with flash floods? Alex Steele and I have been having a big debate on this one. She thinks it soaks in. I'm not quite so sure. That wraps things up for early edition. More surveillance ahead, some great guests, and the return of John Ferro. This is Bloomberg.